Hello, today we are going to be talking on market structure. So, in the last video, I just did an introduction to SMC, which is the smart money concept, uh, the strategy that deals with what liquidity and understanding how and when the market makers wants to make their move in order to trade along with them. Okay, so now we're going to talking about market structure. Market structure is an important aspect of trading. It's one of the important, in fact to me is the most important aspect, because if you understand market structure, you will be able to understand the behavior of the market. It means market price, whatever price action you see in the market moves in repeated patterns, right? Remember, the whole essence of technical analysis is for us to what study past price movement in order for us to determine in probability what price is going to do in the current or in the future. Okay, so market structure is just the study of the behavior of the market, the way in which the market moves. And there are three basic ways the market moves, right? I'm just going to make this very, very easy and simple to understand. You don't need to beat your head around this, right? Just stay calm, you're going to understand everything, right? Three basic ways the market moves. The first is the uptrend, the second, the sideways or range, the third is the downtrend. It means market has a behavior of moving upwards. Market has a behavior of what? Moving sideways. And also market has a behavior of moving downwards. It means whenever we go to our charts, right, we'll be seeing these three ways. We'll be seeing these three ways that the market will be moving. And if we now understand how it moves, we'll be able to catch trades, because the essence of studying, right, all this market behaviors to be able to catch a trade. You want to trade, okay, you want to be able to catch a move. If the market is moving in an uptrend, you want to be able to catch an uptrend move. If it's going a downtrend, you want to be catch a downtrend move. If it's ranging or going a sideways market, you want to be able to identify that, oh, this market is ranging, right, and on what time frame. Now a lot of people says, oh, you hear traders say if market is ranging, do not trade. I love trading the range market. Why? Because it's depending on the particular time frame of which I see that trend, right? Of which I see that particular range. For example, if the market is ranging on the 4 hours time frame, right? I can go to the 15 minute. Inside the range, I might see an uptrend, because a ranging market is a market that moves from a support level to the resistance, right? It's not breaking upwards, it's not breaking downwards, it is just bouncing off a particular support and bounce back. When it moves up, right, it reaches a particular resistance, it pushes back down again. So it means if the market is ranging on 4 hours, for it to make this movement upwards, it means if I go to the 5 minute time frame, 15 minutes time frame, this movement upwards from a support level of the range to the resistance level of the range is an uptrend. This other movement from this resistance level of the range to the support level of the range in smaller time frame will be a downtrend. Okay, so it's also an opportunity. The basic thing is for you to understand the structure of the entire market, right? Market structure helps you to understand how the market moves and to know which specific trend you are trading in. If the market is in an uptrend, you want to focus on catching buys. Basically, you want to focus on catching buy, because when the overall market trend, it means when I mean overall market trends, I mean trends on higher time frame, has more power than trends you see on lower time frames. It means for me to analyze a chart, right, for me to identify what trend, what behavior is the market currently moving in, I want to go to higher time frame. Example, I want to go to the daily time frame, I want to go to the monthly time frame, I want to go to the weekly time frame, so that I can understand the overall trend of the market. Okay, if I go to the monthly time frame, is the market in an uptrend on the monthly time frame? I will now say, oh, the market is bullish in an monthly time frame. So whenever I see a pullback to the downside in that monthly time frame, I know that, oh, market is just retracing. There will be a continuation since the entire market structure on the monthly is bullish. Right now, because whatever happens on the high time frame also happens on the smaller time frame. You might be in an uptrend in the monthly time frame, but when you go to the daily time frame, the market it's in a downtrend. It means that particular trend at that point in time on the daily time frame it's in a downtrend. Now if you go back to the monthly time frame, it's in an uptrend, but what you're observing that you can see on the daily time frame is just market retracing into levels on the monthly time frame for a continuation. So you guys need to understand how this thing works. But basically, if you can understand how to read trends on different time frames, it means study the market behavior from the higher time frame, you go down to the lower time frame. Of course, but as time goes on, we're going to be teaching you how to do that time frame analysis and top-down analysis, understanding the structures from higher time frames down to entry time frames. Okay, down to the entry time frame, depending on the kind of trader you are, and we'll discuss that in time also. But today, I just want to teach you how to identify an uptrend, a sideways market, a downtrend. You can identify these on different time frames, right? It happens, market moves the same way on different time frames. Okay, you just need to know what you are doing and what you are actually looking out for. In an uptrend, the market creates several high highs and higher lows while it goes up. I don't want to uh, bore you guys with the normal conventional ways that we have been taught trading, creating these higher highs and higher lows. The market is creating those level with a break of structure. It means whenever market moves from a lower region to the upper to a higher, to creating a new highs, market was always creates that break of structure, right? Pulls back down again, pushes up, creates a break of structure, pushes back down, pushes up, creates a break of structure. Now this is the conventional way an uptrend has been described for you. But if you are an SMC trader, my uptrend might not look exactly like this. I might have an uptrend like this. Okay, so it may not look as this. You'll be seeing different levels of other structures in it, but the market is in an uptrend just like this, but it is not as smooth as you see it here, up down up down up down. It might be something scattered like this. Why? Because the market creates that moves. We SMC traders believe whenever the market is making those structure, market is always after liquidity. And of course, at every lows and highs that market creates that liquidity for the market to hunt. For example, if I go to a chart right now, let me give you guys an example. Let's see, let me look for an uptrend in XRP. Let me quickly look for an uptrend. Okay, identifying an uptrend, the market is bullish on XRP, so this is a trend. This is an uptrend. What happened? Market is creating what? Series of higher highs, higher low, higher highs, higher low, higher highs, higher low, higher highs, higher low, higher highs, creating that move to the upside. But is the market creating it in this conventional way we know, respecting every low when it goes up? No, the market is not actually doing that. If you look at this, there was a low creating a high, market created a low right here, right? Swing, this is the swing low to the swing high, right? Low, high, creates another low, right? To the swing high here, low, high. All of a sudden there was a low here, there was a high here, market created low and another new high. Then all of a sudden market shift, right? Swept the previous low but continue moving up, right? Creating this simple and sweet SMC setup right here. Previous low, swept. So what happens? Something like this happened. something like this happen instead of the conventional high highs and high lows. We know market created a move like this, broke up, created new low, created new high. So here there is a break of structure, and also here there is a break of structure. Okay, so break structure right here. Then all of a sudden what happens? Market was supposed to respect this low to continue, right? But now market disrespected the low, tapped into a region of demand that created this first break of structure right here to continue the movement to the upside. Okay, so this is the kind of moves SMT traders catch, right? These are the kind of moves SMT traders catch. Okay, when market wants to disrespect the conventional way we know, the textbook way we know of market creating highs and high lows, then all of a sudden, instead of market to respect this and create a new low, all of a sudden market sweeps this previous low, taking out liquidity, right? Because a lot of people have bought from this side, pumping the market to the upside. Then all of a sudden market came, swept them out, tap into the previous demand that pushes the market up for a continuation just like this. Okay, so this is how it moves even in a downtrend. Even in a downtrend, for example, if you spot a downtrend on BTC right here, let me go and look for, yeah, we're having uptrend, so I'll just look for a simple downtrend on BTC right here. Where is it? Where is it? Where is it? Okay. Okay, it says simple downtrend right here. Okay, so basically looking at this, you know that this is downtrend. Then you'll tend to understand how the market moves. Okay, the market was moving like this. Look at this conventional way, right? Creating high, lower highs and lower low, right? Moving in this way, respecting every high and disrespecting the lows. Downtrend, right? This is the conventional way you've been taught. But SMC tells you that, oh, the market might not move in this way. We can start moving something like this, right? We can be moving like something like this. So when you see this structure, higher, lower high, lower low, lower highs, lower low, respected, lower highs, lower low, respected, lower highs, lower low. Then all of a sudden, markets came back and took out what? This particular lower high, right? And it tapped into what? The supply zone of the previous lower high. Then market started continuing the bearish movement. These are the kind of setups we trade on SMC after market has come to hunt liquidity to the downside. So this is the way we look at market structure when we want to catch a particular trade in an uptrend or in a downtrend. Other traders would take their sell position from here. We will be waiting for them to be swept out before we continue the movement to the downside, and you would have caught a beautiful trade if you understand the market structure like this. So we look at what other people do not look at when looking at structures, right? Other people look at market to create high highs and high lows and to respect it like this. Beautiful. This is the future or the basic characteristics of an uptrend. For market to be in an uptrend, before you classify a market to be in an uptrend, market needs to create what? Series of higher highs and higher lows, breaking structure to the upside. This is your conventional way. But for SMC, we believe our structures should be like this: market creating those series of higher highs and higher lows and disrespecting some of them for a continuation, disrespecting some of them for a continuation, right? Disrespecting some of them for a continuation, something like this. Not as perfect as this, but something really, really rough like this. After market creates series of high highs and high low, right? Market comes disrespect, and this is where we want to take our trade for a continuation. We are in an uptrend, of course. We are looking for buys, right? Now, I'm not. The next part of this video, this is just the part one of market structure. It's a wide topic, of course. We're going to spend our time on it. So this is just the part one. The part two will be talking about trend shifts, how the market shifts from an uptrend to a downtrend, and a downtrend to an uptrend. We're going to be talking about the basic conventional way and the SMC way. Okay, so this is what other traders look at, while this is what other SMC traders want to look at. This is what I look at. This is how I expect the market to move, and this is how the market actually moves if you understand structure very well, not the conventional. It will start by creating, right, the conventional highs and lows, right? Then when you see a move, this is guarding a particular low that has broken structure to the upside, you would want to catch the trade from the previous demand for a continuation. You want to catch the trade like this here for a continuation. This is how the market moves, both in an uptrend or a downtrend. Now, like I said, I was talking about the ranging and the sideways market, and I said depending on the time frame, right? A lot of traders will tell you, okay, avoid the ranging market. Of course, yeah. If the market is ranging in lower time frame, 15 minutes, say 15 minutes, 1 hour, you want to avoid. But if I see a market ranging on a daily time frame, I'm a day trader. So if the market is ranging on the daily time frame, or in the 4-hour time frame, or the weekly time frame, a move from a support, right, to a resistance can be an uptrend in that particular range, can be an uptrend in smaller time frame, and I'll be able to catch a particular SMC continuation move, right? I'm able to catch that move. Why? Because the market is moving from a particular support, right, to a resistance, or a particular resistance to a support, while the market is ranging. And of course, it's risky. You have to be experienced, because when the market is ranging, right, it's creating sell side and buy side liquidity, right, on that support and resistance to the upside and to the downside. So what does this mean? It means markets can decide, right, to take out liquidity below and continue moving down, or market can decide to take out the liquidity above, right, then continue moving down, or retest and continue moving upward in a range. So it all depends on how the market wants to make that move. But when you see a break out of the range, then you see particular trends created, maybe an uptrend or downtrend, then you match that with the previous overall structure on higher time frames, then you're able to catch a move. It's as simple as that. I can take you guys to an example of a range we had on BTC recently, before we had this spike to the upside. Okay, you can see this is a typical sideways market, right? On the 1 hour time frame, you can see this range. This market has been ranging from this block, right? You can see market ranging from this zone, right? It's ranging, then before it broke up, right, pulled up, then pulled down for a continuation. So market was swept the upper levels of this range, right? It swept the upper levels of the range. After it ranged, it swept the upper levels, then pulled down to sweep the lower levels of the range. Then market continued moving in the uptrend, right? Because when the market is ranging, there's a gathering of buy side and sell side liquidity. We are going to be talking specifically on that when we are talking about liquidity. For now, we're just understanding the structure. Okay, so now that this market is ranging on lower time frame, you can see the market is moving from what? Support, bounce of resistance, support, bounce of resistance, support, bounce of resistance. There can be opportunity to catch a trade, an SMC trade on the 5 minutes time frame, on the 3 minutes time frame, if you know what you're doing. Okay, so that's that for today. So in our next video, we'll be going deeply on market structure, understanding the trends very, very properly. Okay, so this is just an introduction to this. So we will understanding market structure. We'll be talking about the break of structure. We'll be talking about market structure shift, how market moves from an uptrend to the downtrend, and how to catch those moves.